Hello, my name is Ken Grazak. I'm a mortgage broker in Bloomington, Minnesota, and I write loans in Minnesota, Wisconsin, and Florida. And I'm shooting this video because I want to try and explain the underwriting process so that you can get a better understanding as to how that process works and get a clear expectations on the process itself. I'm going to start the video off by talking about the mortgage cycle because I think that's extremely important to understand the cycle. And if you understand the cycle, then you'll understand why sometimes the underwriters come back and do what they do. So if you got any questions after this video, feel free to reach out. I answer any questions that you have, and I look forward to getting your feedback on this video. Thank you. All right, so what you're looking at here is the mortgage cycle. What the mortgage cycle is how a loan gets basically created and funded. And by understanding that piece of the transaction, it will help you to understand the underwriting process and why the underwriter does what they do. Now, as a borrower, you go to an originator for a loan, whether it be a refinance or a purchase. The originator, the loan officer, is going to put that loan through a mortgage lender, bank, company, who then was going to fund the loan. That mortgage bank company knows that they can't hold on to the loan due to the interest rate risk, so they sell it to an investor. Now, that investor is going to basically take your payments and then is going to pay out your taxes and insurance if you have escrow. But the investor purchases and services the loan, then sends it to an aggregator. The aggregator, when we say aggregator, we mean Fannie Mae, Freddie Mac, FHA, USDA, VA, depending on the type of traditional loans you're looking at. They're going to collect the mortgages and create large pools, but still they can't hold the loan. So they package and sell them to Wall Street. Then Wall Street turns it into a mortgage-backed security and then sells it back to the borrower in a 401k or a mutual fund. Why this is important to know is because the originator, you need to have somebody that knows what's going on, is watching Wall Street, understands mortgage-backed securities, understands trends, because then they can give you good advice as to where they see the market going. Also, you need an originator that understands the guidelines. So the risk threshold is set by the aggregator. The aggregator is going to create the guidelines, which in some instances is 1,500 pages of guidelines. And they're going to create these based upon the risk of the ability to repay back the loan. And there's all sorts of pieces that go into that, but that's what the aggregator does. They see trends of risk, so they change the guidelines to make it tougher. They see ways that they can open it up, so then they open up the guidelines. Now, the originator has a tool. They have the AUS, the automated underwriting software, and they're going to take the application that you submit to them with the documents that you've submitted to the loan officer, and they're going to take that information, they're going to put that into this AUS. To start the process with a loan officer, most loan officers are going to do what's called a soft pull credit, which means it's not going to affect your credit. It's just to give an idea, and that way then you have an idea if you can actually get pre-qualified or you can actually make sense to do a refinance. When the originator takes that information and puts it into the AUS, they need to do what's called a hard pull. And the hard pull is going to allow them to get an accurate approval from the automated system. At that point, if you have the income and the assets make sense and your credit looks good and it goes to the automated system and says you're approved, you're able to do what's called a pre-approval on a purchase, or you're able to submit to underwriting for figuring out if they'll approve your refinance. Now, when we're submitting to underwriting, we're submitting to the mortgage company, and that's where the mortgage company has the underwriters and is making sure that they're doing everything that makes sense to the guidelines. Their underwriter is using their experience and they're using the guidelines to approve and final approve. Now, that process is almost a 3-step process. You've got the pre-approval or the initial, where the loan officer is putting it through the automated system. Then the underwriter is going to do their initial review. They're going to it's a human taking information in, and they're making sure that it makes sense to the automated system, and they're giving their feedback. And what that normally happens is it leads to what's called an underwriter condition. And so you may have 5 underwriting conditions where the loan officer needs to get more information from you. The goal is to only go to the underwriter twice. If you go to the underwriter twice, it just makes the whole process easier for everybody. But it may end up going back to the underwriter 3 and 4 times, depending on how difficult your file is for underwriting. Now, the underwriter will take a look at that 1, 2, 3 times. And then at the end, they're going to take a look at your appraisal, and they're going to take a look at the title work, and they're going to take a look at your assets and your income. And they're going to make sure that it all makes sense and fits the guidelines. And when it does, they're going to offer their clear to close. So it's extremely important if you've got a loan officer that's coming back to you and asking for conditions that you get them the conditions as fast as possible. I usually suggest within the first 24 hours because that way you know that you're going to have the turn times of underwriting, and it's just going to lengthen out the process if you don't get it back to them quick enough. That's another key question to ask your loan officer. How long is your turn times? As a broker, I've got access to a bunch of different banks, so I can find the bank that's getting us the quickest turn time if we need it, which is awesome. Now, once the underwriter has approved it, given their clear to close, you've closed on that transaction. That mortgage company then is going to sell it, and they're going to offload it or whatever. They're going to sell it to the investor. The investor then is going to get it to Fannie Freddie, to the aggregator. Then the process flows. So an originator that understands guidelines, an originator that understands where the securities are going, is going to be the person that you want to work with. And if you have any questions about that, you can definitely fill us in, and we help you. If you have any questions about this mortgage cycle too, let me know. Thanks. Okay, so we've spent a little bit of time talking about the mortgage cycle. I feel the mortgage cycle is extremely important to understand, because if you understand the mortgage cycle, then you'll understand the rest of this video. Now, we will run your file through what's called AUS. AUS will come back and say, these are some things that we need to get from the buyer. So, or somebody is doing a refinance. Maybe what we put in there for the value on the home is going to match what they feel the value is, and they're not going to ask for an appraisal. Maybe the documentation that we put in there is going to match what they feel the documentation should be, and they're not going to ask for a whole lot of documentation. But for the most part, they're going to ask for the last full months of pay stubs. They're going to ask for the last 2 years of W-2s. If you're self-employed, they're going to ask for tax returns because they want to take a look at that. If you own a rental property, they're going to want to see the rental income on the taxes. They're going to want to see the credit because they want to know that you have good credit. They're going to be offering you a big loan. They're going to want to take a look at your assets. They're going to ask questions on the assets. If you have a bunch of large deposits, maybe you're just dumping cash into your account, they're going to ask questions about that because they're going to want to understand where this money's coming from. They're going to want to make sure you're not taking a loan out, is what they're truly looking for. So these are things that we try to get in advance when we submit this file to underwriting, but we can't always catch that. So there's 3 phases or 3 steps when it comes to the mortgage underwriting. The first step is going to be doing that AUS, getting a feel for what you're going to get approved for based upon what the guidelines are. The second step is submitting it to the underwriter. The underwriter is going to probably look at this file 2, maybe 3 times. Our goal is to have the underwriter only look at the file twice, and it's extremely important when the underwriter gives us conditions that we get him the conditions or her the conditions back. So we would submit everything that you've sent to us during that pre-phase. We submit that to the underwriter. The underwriter then takes a look at it, has questions about income, or maybe has questions about the assets or the bank statements or something like that. So then we request information from you so we can submit it back to the underwriter. The underwriter is also going to take a look at the appraisal, is going to take a look at the title work to make sure that the actual property itself makes sense for what we're trying to do. Property that appraisal comes in $50,000 low is going to be a concern to the underwriter because they are going to lend based upon what the value of that property is, and they don't want to lend over what it's worth. So those are things that the underwriter will take a look at. We submit to the underwriter looks at the file, bases their opinion on the guidelines and their experience. They send us information back. We request their conditions that they have, and we resubmit them. And if what we've resubmitted makes sense to them, and they've looked at the title and the appraisal, then they're going to give us what's called our clear to close. And once we have our clear to close, that underwriting process is done unless something crazy happens. And I've had this happen in the past where maybe a borrower buys a car before they close, or they take out a loan to get furniture before we close. Things like that will affect anything that or they have an issue with income. Maybe they get laid off before we close, or maybe they have a change of employment before we close. I had one borrower that got married a week before closing, and that created problems that we had to fix because the underwriter then was asking for more questions. So if something changes with your profile that's different than what you submitted, the underwriter is going to ask questions, and we're going to have to get the underwriter back their conditions. So it's extremely important to understand this. The underwriter is also going to do what's called a verification of employment at the very end. They're going to do a verification on your credit too. So they're going to know that you had an inquiry. They're going to know that something's changed on an employment. So you're going to want to make sure that you're doing everything you can to let your loan officer, your loan team know what's going on, because it's going to get caught at some point, and you don't want to be sitting there 2-3 days before closing and having a problem. So this is the underwriting process. It can be as simple as a 2-day, 3-day process where underwriting turn times are 1 to 3 days. It can be a 5-day process. Maybe underwriting, maybe you've got a more complex situation and it's a 5-day underwrite. Those are things that you need to ask of your loan officer to make sure that they give you the proper expectations for that. But this is the underwriting process. If you have any questions on this, feel free to reach out. I'm here with whatever questions that you have. I know we run a gold service type process here at my team, Grazak, doing business as CFR Mortgage. We will be here every step of the way for you, and we'll be giving you that top end service. But if you have any questions about the process, feel free to let me know, and I'm here to help. Thanks for watching the video, and I look forward to talking to you in the future.